I am going to take one more example out here. Let us take one more example. Let us try and see if we can solve this example out there. Let me go back. Let me go back and share my screen out there. Let us try and solve this. It says that Gillette, Jimmy and Thomas operate a food truck. They sell made to order burritos, tacos and whatever and etc. at a price of over 10.25 per order. Each of the items cost them on average 4.1 for the protein, rice, veggies that customer choose. Their food truck include licensing cost of $250, insurance of $1260 and depreciation of $5,500 per year. Now, first thing, what is the break-even point in units for Tecologos? What that is, they operate a food truck. That food truck name of the Gillette, Jimmy and Thomas operate a food truck. They sell made to order food items for about at a set price of about $10.25 per order. Each of the items cost them about 4.10 for the ingredients and so on. Their food truck expense includes a licensing cost of $250 per year, insurance of about $1260 per year and a depreciation of about $5,500 per year. Now, what is the break even in units number of orders for GJT out there? So, let us sort of calculate out there. I have just tried to calculate. I am trying to use an Excel sheet out here. The fixed cost I am going to lose down. The fixed cost is going to be licensing cost is about $250 per year. My insurance is about $1260 per year, and then my depreciation is going to be about $5,500 out here. So, my total fixed cost in this particular case is going to be my total fixed cost is going to be about $7,010 out there is what I see as my total fixed cost. Now, let us look at my variable selling price out there. My selling price is about $10.25 per order. My variable cost is about $4.10 per order. So, my contribution is going to be, this is going to be my contribution of about 6.15. What is my break even in terms of orders? Break even in terms of orders is very simple. My fixed cost out here divided by my contribution per unit. This is the number of break even that I am going to have it per order. So, basically I am going to round it off in this particular case. 1140 is going to be what I am going to take in this particular case. Let me just do that, do the what do you call it as the in this particular case, let me eliminate what is called as a decimals out there. What is the break even in terms of value? This is the number of orders I have to sell. What is the order price? Price per order 10.25. So, break even in terms of sale value, this is going to be the break even in terms of the sale value out there. So, that finishes my first question. Next, second. Calculate GJT's operating income for the year if it sells 2000 orders this year. They are going to sell about 2000 orders out there. Now, sales in number of orders, they are going to sell 2000 orders. What is going to be my contribution? 2000 orders is going to be what they are going to sell. What is the contribution per unit? My contribution per unit is 6.15. So, they are going to get about 12,300 net after covering the variable cost. After covering the variable cost. What is my fixed cost? My fixed cost does not change, it remains the same. So, what is my profit? My profit is contribution minus my fixed cost yields me what is called as my profit out here. Again, if it is sell 3,500 orders, how does it change? Now, let us say 3,500 orders. What is my total contribution? My total contribution is, this is what is going to be my total contribution. I am sorry, I made a mistake. It is not, I multiplied it by sale. It is basically my total contribution, multiply it by contribution out there. This is going to be my total contribution. My fixed cost is going to remain exactly the same out there. What is my profit? My profit is going to be, this is going to be my profit. If it does sell 3,000 orders a year, what is the margin of safety in both units and dollars? Margin of safety out there. Margin of safety, now let us look at in number of orders. What is the number of orders you are selling? 3,500 units. What is the break even you had to get? 1140. So, what is the margin of safety? 2,360 is the margin of safety. In terms of value, very simple. I have my orders out here into what is the selling price per order minus what is the break even number of orders out here into the selling price per order. That is all is going to give me what is called as the break even in this case. Now, I'm going to add one more question out here. I'm just adding a question out here in this particular case. I'm just adding a question out there. Let us calculate what is the degree of operating leverage out there. Let us see what is the degree of operating leverage in this particular case out there. That is operating leverage. Let us say if it is at, let us say it sells about not 3,500, it sells at about let us say 2,000 units out there. What did we say as the degree of operating leverage in this particular case? Let us go back to the slide. Degree of operating leverage is what? Contribution margin by operating income. Contribution margin by operating income. What is the operating income if it sells 2,000 orders out there? The operating income if it sells 2,000 orders out there is in this particular case 5290 is the operating income out there. So, what is the degree of operating leverage? It says contribution margin divided by operating income. What is the contribution margin? It says $2,000 is the 2,000 units is what I am going to sell. What is the margin per unit? Margin per unit is 6.25 and then divided by what is going to be my operating margin in this particular case. This is my operating margin. So, I would say 2.33 is going to be what is called as my operating leverage in this particular case. That means if they say my sales is going to increase by 10% out there, let us say 20% out there, my sales is going to be 2,400 out there. That means how much will your operating income increase? 20% of my operating income in this particular case is what is it as a percentage of sale out there? What is it as a percentage of sale? As you saw in this example out here, you see this, my operating income is going to increase by how much? My operating income, what do you call it as? It's 20% increase in sales. If it's going to be 20% increase in sales out there, if it's going to be 20% increase in sales, 2,400, that means what is going to happen? It's going to be this into 20% is going to be the increase in my operating income. That is 46.50% is going to be the increase in operating income. Let us verify. How do we verify? Contribution, this into 6.15 contribution. Fixed cost, the same. My profit, let us see, is this. What is the increase in profit? Is the increase in profit 46.50%? This is the profit last time into this percentage, that is into 146.50% out there, into 146.50%. Let me see, it's exactly the same out there. Into that is 46.50 is basically what you call it, or you want to take it and multiply it, take it and multiply it out there into 46.50%, that is 26460 is your profit increase. Difference between the two, difference between what you call it as these two, that is your profit has increased by how much? You can basically see here, it is exactly increased by the same amount out there. That is what your degree of operating leverage gives you. That is what your degree of operating leverage gives you out there. Am I with you on this? Now, let us take up the next aspect. Let us take a comprehensive example. I have taken a comprehensive example of abacus out there. I have taken what you call it as how do we use this contribution analysis for various kinds of decision making. Now, this is a company which is operating and they see that they make a loss of about $4,500. They want to come out of this loss. They are trying various alternatives, as you can see out here. case 1, case 2, case 3, case 4 and case 5 and 6, they are trying about 6 different alternatives out. They want to see which alternative is going to work, which alternative is not going to work. They really do not know at this stage, but they are trying to say that how can I get out of this situation out there. So, they are giving you some alternatives. Let us try and see if we can work on some of these alternatives and go on out here. Let us move to the next. I am going to use the Excel sheet out here. I am going to use an Excel sheet in this particular case. I've just used a. I'm going to use. I'll be using an Excel sheet. I'm sorry. I don't know why the Excel sheet is not coming up. Oh, okay. Yeah, Excel sheet out. Now let us go to question number 1 in this particular case. The primary effort is to identify the level of production of contribution that Abacus derives to make any meaningful decision. Can we calculate the fixed and variable cost both per unit as well as and the contribution at this stage? First is let us look at the variable cost and the contribution. Now it says number of units sold in this particular case is about 90,000 units is what I am selling out there. I am just noting that. So, what is the sales per unit? Let us say this is per unit out there and this is what you call it as total out here. So, this is the total. What is the direct material? Direct material is about 1,80,000 is what they have reported. This 1,80,000 means that means per unit it is going to be what do you call it as per unit is going to be 1,80,000 divided by 90, it is going to be 2 rupees out there. It is basically going to be 2 rupees in this particular case per unit out here. I am just going to format the cell 1 minute. Yeah. Next I see direct labor in this particular. Direct labor is about 90,000. So, it is the same thing out here, applies the same thing out here in this particular case. So, that is about 1 rupee out. Then variable factory overhead that we see is about 18,000 rupees in this particular case. So, again the same thing out here, it is about 18,000 rupees and that is about 0.20. Now, there is a fixed, let us come to the fixed later because we are looking at calculating contribution out there. So, when you are looking calculating contribution out there, we are not looking at what do you call it as the we are looking at only the variable cost part. Next, there is a fixed cost, gross margin, selling expenses, variable selling commission is about 18,000 rupees out. But they say commissions are based on sales revenue, other variable expenditure on units sold. So, sales revenue this is again 18,000 out here. That means it is going to be per unit, it is going to be how much? Per unit it is going to be what do you call it as 0.20. This 0.20 translates to about 4% out there. 4% if I am wrong, yeah, 5 into 5, 4 is 20, 5 into 4. It is about 4% of 5 rupees is $20, 20.20. 4% of 5 rupees is 0.20. It translates to about 4% out there. I have written it down very clearly. Next we move on. Variable shipping, my shipping cost is about 3,600 out there. So, that is going to be what 3,600 per unit it is going to be, this is what is the cost per unit out there. Then I have my fixed admin and advertising salaries, I am ignoring that. Then I have my variable admin expenditure of 4,500 out there. So, 4,500 variable divided by 90,000, it is going to give me about 0.05. This is what I call it as a variable cost. Now, let us say total variable cost in this particular case, total variable cost in this particular case out here. Let me just take that. My total variable cost, this is going to be my total variable cost here 3.49. I am just going to pull that into, sorry, I am just going to copy it and paste it out here. That's what is going to be the what do you call it as the number out here. So, what is the contribution per unit? Contribution per unit is $5 minus the total variable cost. This is what is going to be the contribution per unit. Now, I have a series of fixed costs out there, that is, let us start with advertising and salaries about 40,000. Let me hide this, yeah. Then I have my factory fixed admin, my factory overhead is going to be about fixed factory overhead is about 80,000. My fixed admin is about 20,400 what I have. So, ultimately my total fixed cost is going to be this plus this out here. So, that is going to be 1,40,400. What is going to be my profit? My profit is going to be, in this particular case, whatever is the total contribution minus the fixed cost is going to be my profit out there, and I can get my total contribution. So, what is happening? If you see this, it is basically a loss of 4,500, exactly what they have got out here, and that is all what we have. What have we done? We have just split. We have just split what is called as the variable cost and fixed cost and calculated contribution. That is all what we have basically done out here. That is what they asked. Now, let us go to the next option out there. I'm just going to move to the next option out there. There are a couple of options. What you see, I'll see what is option 1, what he has said, what he has done out here. There is question number 1, question number 2, option 1 out here. In this particular case, option 2A, that is case 2, 2A and 2B. He has studied the market potential and believes that an increase in 15% cut in price would fill the plant to capacity out here. Now, let us see what is the capacity at which the plant is operating. The plant is making 90,000 units out there. It has a capacity of 1,50,000 units per year. So, a cut in selling price will make it, what do you call it as, will fill the plant to capacity. So, let us all what he has done out here, option, let us take this, I will come back to that slide. So, what does he say? Now, number of units is 1,50,000. What is the price going to be? Price is going to be, this $5 was the price initially, it is going to be a 0.85, 85% of that is going to be the price out. Now, all these costs are going to remain the same, the direct material is going to remain the same, the direct labor is going to remain the same, the factory overhead is going to remain the same, the sales commission will be 4% of this, will be 4% of this out there. My shipping cost is going to remain the same, my variable admin overhead is going to remain the same. What is going to happen? My total variable cost is going to be, this is my total variable cost going to be. My total variable cost will be, basically I am just going this calculation out here, I am just doing this calculation out there, I am just going to do this. My total variable cost is going to be 3.46 is what I see here. What is going to be my contribution? My contribution is going to be 4.25 minus this is what is going to be my contribution out here. My contribution is 0.79 is what I got out here in this particular case, and my total contribution is going to be this into the same thing out here. This is what is my total contribution going to be. My fixed cost, of course, no change in the fixed cost, my fixed cost is going to be the same. So, what is going to happen? My profit or loss is going to be the difference between these two, then it basically gives me, so the fixed cost will be exactly the same, if the fixed cost is the same, then that gives me a loss of about 21,900. So, option 2A, that is what you saw on the slide out here, is not a great workable option at all. It in fact increases the loss. Let us look at the other option. He wants to increase the price by 25%. To increase the advertising by 1,150,000 and to boost the commission on sales to 20%. Under these circumstances, he thinks the unit volume will increase by 50%. Let us keep this. So, what are three things? Price increase is 25%. Advertising budget is 1,50,000 more, then commission is 10% more, my sales is going to be 50% more. Let us go to the Excel and try and see if we can work on all that. What is going to be? It's from the base. So, this is going to be, my volume is going to be 150% of it. So, all these costs are going to remain basically the same out here in this particular case. My costs are all going to remain the same in this case. It is going to be, this is going to be the cost out here, yes, this is going to be the cost out here, yes, this is going to be the cost out here, yes. My sales commission is going to be, what do you call it? He says, what is my sales commission? My sales commission is going to be 10% on the sales. My sales commission is going to be 10% on the sales. What is the sales price? We have not discussed the sales price out there. Let us discuss the sale price out there. The sale price, he says, is increasing by 25%. So, 25%, that is $5 out here into 125% out there, that is going to be 6.25, and my commission is going to be 6.63 out there, whereas all the other costs are going to remain the same out here. All the other costs are going to remain the same out there, and let us say the total of these variable costs in this particular case out there, that is nothing but my total of my variable cost is 3.92. My contribution is going to be 6.25 minus 3.92 is going to be my contribution. My total contribution is going to be this into, what is the amount here, 3,15,000. And what do they say? My fixed cost out here, my fixed cost in this particular case is basically, what do you call it in this particular case? My fixed cost out here, my fixed cost out here, that is, my fixed cost is the same 80,000, yes, my 40,000 is my ad, etc., etc. He says that my advertising budget is to be increased by 1,50,000. My advertising budget is going to be increased, that is for 2B, the increased advertising cost 1,50,000. Now, my fixed admin cost is 20,400. So, what is my total fixed cost? My total fixed cost is this, this is my total fixed cost out there. So, what is my ultimate profit? My ultimate profit in this case is, yes, this is my profit. My profit is 24,825 in this in this case. Like that, there are other options. Case 3. In case 3, what he says? He does not want to tinker the price. How much can the advertising be increased to bring production and sales to 130,000 units and a target profit of 5%. Target profit is 5%, production and sales will be 1,30,000. So, how much can the advertising be increased? Here's another option where he is getting a special order from the government and so on. So, what I would like to do at this stage is, I would want you guys to think through what we have done here, question 1, 2 and 2A and 2B. 3, 4 and 5, we will take it up further, but spend some time trying to understand this. Then we will proceed further with the same example.